Hello and thank you for tuning in for Ascending Abundance YouTube channel, where I cover strategies on how to make money, hopefully quickly, absolutely legally, through deploying strategies in the stock market, crypto, or real estate. My main objective is to make sizable capital gains, isn't gain the capital, not capital gains from tax perspective, in every possible way so that we don't focus on living frugally and saving every dollar, but instead focus on abundance and focus on making money for our families to enjoy this life to the fullest. This is different for everybody, and I do respect everybody's opinion. However, my approach is focused on making a capital grow as opposed to saving every buck. This strategy is a straightforward put option spread. It's just an example on how it could be executed and what kind of rates of return we're looking at. So for this example, I've picked NASDAQ 100. One of the best known ETFs is QQQ. Billions of dollars are invested in these technology stocks. It's a combination of multiple stocks, so the likelihood of all of them going down does exist. It's not a riskless strategy, however, that risk is smaller as compared to playing with an individual stock. So looking at, well, I call it stock, it's an ETF. Looking at today's price, today is February 21st, it's a long weekend. Today's price is $301. When I look at the chart, I've put one here, I kind of like the support of roughly $250. Not that it cannot go below it, it absolutely can. However, the stock market has been going down steadily for over a year, which is a lot for a stock market. It went down percentage-wise quite sizably. The interest rate hikes are continuing, but they're definitely slowing down, and companies are adjusting. Their valuations have come down significantly, so I do kind of like the support at about 250. It's just something that I've selected. I'm not huge in technical analysis. However, it will be kind of silly not to deploy any technical analysis when doing option strategies. So at the strike price of 250, that gives me a discount of 16.9% off today's price. Can the stock market, and specifically QQQ, can it fall below 16.9% over the 2 months period? That's the period that I'm selecting for this strategy. It absolutely can. So again, this is not a riskless strategy. However, given the considerations, the risk return ratios, however comfortable you are with it, I suggest to proceed. So at 16.9%, the option strike at 250, the put option premiums right now at $1.35. One put, as a reminder, is 100 shares. So at 100 shares, one put will get you $135 in premium. If you sell 10 puts, that's 1,000 shares, and 1,000 shares, the premium is $1,350. So far, so good. However, there could be some catastrophic events, black swan events, who knows, maybe there's a nuclear war, maybe everybody decides to sell off from the market. I don't want to be exposed and be on the hook for 1,000 shares of QQQ of $300 each. That's $300,000 of exposure that I'm absolutely not ready to deploy in this particular strategy. So looking at it from the technical and non-technical perspective, I just kind of said, you know what, I want to cap my exposure at about 220. So if I'm selling a put option, I'm exposing myself, I'm giving somebody else the right to sell me those shares or those units at 250. Well, I'd like to buy a similar right and have a protection. This is like my insurance policy. If it were to drop below 220, which is 26.9% of today's price, then I'm protected. I can then sell these shares to somebody. I have the right to sell these shares, these units, at 220. To buy those, the put option premium at 220 is at roughly 37 cents. 100 shares, that's $37. You sell 10 puts, that's 1,000 shares, $370. So I would be earning or getting the premium of 1,350. I'll be paying 370 roughly. And that gives me the exposure, kind of the bands in between 250 and 220, between 16.9% drop in QQQ, and then I'm covered if it goes below 26.9%. I'd like to remove that tail risk. Who knows what's happened? It's really hard to estimate. If you read Nassim Taleb's books, the drop could happen at any minute. It could be triggered by pretty much anything, another COVID, God knows what happens. So I don't want to be overly exposed. Plus, it saves me on margin. So all of this exposure below 220, because it doesn't exist, the brokerage at which you're going to execute this trade is going to cap your exposure and only tie up the capital sufficient to cover the spread between 250 and 220. Everything else you don't have to have capital against because you are covered. There is a protection, there is this put option that you bought. Anyway, so what's our exposure? Exposure is 1,000 shares between 250 and 220. That's $30,000. The premium earned is the difference between 1,350 and 370. That difference is $980. So far, so good. I'm calculating my return. I'm making $980 on this $30,000 exposure. That's 3.27%. Not exciting whatsoever. Like 3.27% is not going to make you rich. However, if we do this every 2 months, we're right now in February, I'm writing this for April, it's 2 months for exposure. You do this therefore 6 times a year, right? Every 2 months. And if you earn 3.27% every 6 months, your rate of return becomes 19.6%. Now there are some transaction costs associated with this trade. You obviously have to pay for the options. There is a tax consideration. This could be active business income. This could be capital gain. I don't know the taxation in the place that you live and where you're executing it. However, if we take this as an estimate, and we could round it up and down a bit, but it's roughly 20%. That means if you perform this strategy, it earns you roughly 20% on this risk. And if you continuously do this, it takes 5 years to double your investment, right? So it takes 5 years of successful performance to make up the 30,000 bucks that you're risking. How likely is it that within the 5-year time, you're going to encounter a drop of, let's say, 17% in the price of QQQ? It is possible. It is definitely possible. So I do not recommend deploying this strategy sort of mindlessly, ongoing. Every 2 months you just sell those spreads and do this forever in your life. Very likely at some point you're going to lose money, and it's going to suck if you lose the entire 30,000 before 5 years expiry. So you're going to kind of make money, then oops, and you lost all of the 30,000. So the overall strategy backfired, and you really spent all of this time hoping to be making money, but you really lost. So what I would recommend is paying attention to the market. It's really hard to time it. However, the drops of 17% within 2 months periods don't frequently happen, and they don't happen for no reason. So if you see that there is a war happening, you see that there is some sort of unusual COVID type of event, there's something that is really making the markets jittery, don't do this trade. Or if you're already inside of this trade, well, maybe close out of it at the half of the premium. Sometimes maybe you're going to have to even pay to close this exposure. That's okay. So play it by the ear. It's not a guarantee. However, at a 20% rate of return, after a significant drop in QQQ, after all of these price raises and the war with Russia and the COVID and God knows what else, I feel much safer. I think there's a lot of risk that's been taken out of the market. And with the 20% return on the $30,000 exposure, I feel fairly confident. And God forbid if this is completely going to go and I'm going to lose the 30,000, well, I'm not going to go bankrupt. This is just one of the few strategies that I deploy, and it seems to be promising a 20% rate of return. I've done well with it previously. So, deploy at your own risk, and thank you very much for watching. If you want to discuss any of these strategies, you have any comments, you don't believe this is valuable, or you do believe this is valuable, please connect with me, hit that like button, subscribe button, help this channel grow, and I'm going to share more wealth building, money making strategies in these videos. Thank you very much. Appreciate you.